Andy Nygard, who is a certified financial planner and has been in the community for 20 years and has really specialized in helping Vancouver people with their investments and all the rest, especially related to retirement and everything around that. And if there's anything that I have come across as a pastor over the last couple of years especially, it's people who say, wow, didn't plan quite for this, and were turned upside down by the recession and realize I've got a lot more years than I've got money, or so it seems, and how in the world am I going to navigate this whole thing? And it's kind of scary for some people. And they had planned for certain values in housing that turned upside down, and a whole lot of other things. And how fast do you come out of that? What do you do to risk things? Do you not risk things? Help, what do you do? Andy is a guy who happens to be involved with a company locally, but he's not here to sell something to anybody. He's here to unpack what the issues are. And so he's actually a guy who is on the point for his company around the United States now. Is getting a lot of press, and they're using him as a speaker in a lot of places, and has been part of our church for a bunch of years, and just a wonderful part of the church. So if you didn't get one of these, this is, again, it's not a sales piece. It's a piece that should just give you some ideas of things you need to be dealing with. So with nothing further, Andy Nygard, let's give him a hand.
Thank you, Bill. How's my volume? Sounds good? Interest rates are at record lows. Government gridlock is rampant. Taxes aren't going down, and the media reminds us that things are mostly bad. What's a next stepper to do for financial security? That's why you're all here, other than the habit of coming down on the second Sunday of every month. So hopefully I can give each of you a little something to take home. Bill mentioned the pens and the pads. I know we have a diverse group here. Maybe you're already retired, looking for some new strategies in this low interest rate environment. Maybe you're just scraping by, looking for a little breathing room and how you can free up a couple of dollars for your finances. You might be a sophisticated investor, have a lot of resources, and you're here because you're looking for a confirmation of a strategy, maybe that you're using or you're considering, or the person that you're working with, are they doing a good job? Maybe you're planning for retirement. You're right on that edge. And boy, this is really a critical decision point for you. At what point do I really pull the plug? Do I do something different? Do I move into that next step? Regardless of where you are in life, I hope that even with all the diversity here that we have this evening, you all can have something to walk away from that will help you in your own finances to feel a little bit better about what's going on in the world and in your own personal financial life. So I did get some questions. Jackie forwarded on questions that those of you, when Bill had asked, I think most of those questions get answered either directly or at least a little bit around the edges in my remarks. So I want to tell you about the 4 things that we are going to cover, and then maybe touch just briefly on what we aren't going to cover this evening. So we are going to unpack your financial life as it relates to 4 things: your expenses, your income, your resources, and your risks. And as we go through each of them, I'll explain a little bit more deeply about what it is that we mean with regard to all 4 of those things. And then we're going to try to look at them from every angle that we possibly can. What we won't cover is things that we can't control. We can't control government. We can't control entitlement spending, medical issues, politics. We can't control your individual situation. I would love to sit down with each of you and unpack your particular situation. This isn't, of course, the forum that we can do that. But I think these 4 things that we're going to unpack will apply to all of us, so that I hope that what you do is take away something from that tonight that you can really apply in your own lives. At the end of it, we're all faithful. those things that we can't control, we have to give over to God. I asked Bill for a little bit of scripture. I said, do you think it would be appropriate for me to stand up here and talk to you about your faith? And secondly, what should I say? So I handed it to the right guy. I'm going to read for you exactly what Bill sent to me, because obviously I can't say it any better. He says, on one hand, the parable of the talents in Luke 19, 11 through 27 teaches us that we need to be good stewards of the resources given us to manage, that God doesn't want us to presume upon his provision. On the other hand, in Matthew 6, we're told not to worry, that God knows our needs and makes a way for us. Interestingly enough, however, clearly, God expects us to have skin in the game. If we're faithful to manage what we have, he builds on that. If we aren't, we will not find the future we're looking for. In all things, God's in control and wants our best. The question is whether we're willing to follow him. So what we're going to do tonight is get started learning how to be good stewards. With regard to your expenses, how do we look at expenses? How do we review them? How do we manage expenses? How about your income? Where does it come from? When you're at this stage of life, for most of you, your income comes from multiple sources. When you're working, you get a paycheck. But once you're retired, you've got a couple of different pools of, we call them MSIs, multiple sources of income. The more M's you have, the better. How reliable are those various sources of income, and how variable are they? Okay, so we're going to cover that. We're going to talk about your resources. And what I mean by resources is not just investments, but all of your other assets. You might have rental property. You might have annuities. You might have savings accounts and CDs and money market accounts. You might have an expected inheritance of some kind at some point. And how do we manage all of those? We're not going to get into specific products. We're not going to get into specific types of investments. But we're going to talk about some of those things in general, in general ways. And then risks. For most people who have balance in their retirement, there are really only two things that can upset your financial security in retirement. One is an unexpected, or maybe even expected, increase in your expenses, or a decrease in your income. So how do we mitigate or manage those risks that exist to all of us when we really don't want to go back to work? So let's start out with expenses. Does anyone not have expenses? So I'm in the right room. Everybody's got expenses. They got to worry about them a little bit. What do you do to control them? Your expenses are your house. Whether your house is paid off or not, you've got homeowner expenses, you've got a roof to put on someday, you've got landscaping to do, you've got bills to pay. You have taxes on your property. You've got income taxes. You've got insurance payments, cable TV, cell phone, every morning coffee, etc. So how do we control our risk? How do we manage our risk? And what can we do to really get our expenses under control? The first thing that I would suggest, if you don't have a good idea, and you'd be surprised, I ask, one of the first questions that I ask with clients when we're sitting down is, what do you spend each month? And I'm always surprised. I don't know. Sometimes they don't know. You might not know what your expenses are. To analyze your expenses, pull out your bank statement or pull out your checkbook and start with the biggest number in the minus column. Okay? Your biggest expense, what's the next one and the next one and the next one? And sometimes you've got expenses that might only come up once a quarter or twice a year. So don't just look at May because your property taxes came out in April, and that was a pretty big expense. So start with your biggest expenses and work your way all the way down to the little ones. And if you are looking to find some room in your expenses, where can you cut? Most of us are familiar with some of the easy ones, right? Clip coupons. Some of the big ones might surprise you. I have a lot of clients who come to me whose house is almost paid off and they're paying $1,500 or $1,700 a month, and they can't wait to get their house paid off because they're down to the last $10,000 or $15,000. But you know what? It's their biggest expense. And if all they do is refinance into a 30-year mortgage, that $1,500 payment would go down to $179 for the rest of their life. So every single expense should be analyzed from how much is it? How relevant is it? How locked into it am I? Are there any ways that I can reduce it, or any ways that I can mitigate it, or any ways that I can avoid it? Timeshares are really popular. Those are a pretty big expense for some folks if you're in that category. I think you look at something like a timeshare and you say, well, how often am I going to use this? Is this really important? Getting rid of it is another story, but expenses is one of the things that you want to look at when you're understanding what your financial life looks like and how you might be able to create a little breathing room for yourself. How do we reduce our expenses? Now, if you have a balance between your income and expenses, congratulations. I'm not saving a whole lot, but I'm not going underwater either. That's really important for you to have a balance. If you have more month than money, or more money than month, we're probably almost all in that category. Hopefully you've managed to find balance. So let's talk about income. Some of these are going to take a little longer than others. Expenses is a pretty quick one. Your incomes and your multiple sources of income can be one of the most complex pieces of your retirement income. There are so many variables with regard to the different sources of income that you can have in retirement, where that income comes from, how it behaves, does it go up over time? I like to say there's 3 types of income. There's fixed income, there's variable income, actually there'd be 4, rising income, and we hope we don't have disappearing income, but that'd be the one. That'd be the 4th one. What kinds of income do you have? What type of income is it? And what do you rely on? How much? What's your reliance rate? If I get $1,250 a month from Social Security, what is that as a percentage of my entire budget? Is it half of my budget? If it's a Social Security payment, how reliable is it? I would have to say Social Security income is pretty darn reliable income. It's also rising income. It doesn't exceed inflation over the years, but it's supposed to keep up with inflation. But what percentage of your total budget are you relying on for Social Security? If it's a major percentage of your budget, that's okay, that's great, because it means that you have a highly reliable source of rising income for the majority of your budget, and you're in pretty good shape. If it's a smaller portion of your budget, what are those other sources of income that you rely on to make up your month? Now, I want to back up a little bit, and I want to talk about Social Security. How many of you have not yet filed for Social Security? Anybody? Okay, there's a big chunk of you in the room that have not yet filed for Social Security. You should know what your full retirement age is. Your full retirement age for the vast majority of you is probably age 66. It may be a little bit before that, a little bit after that. It's based on your birth year. Your full retirement age is the age at which you get your full Social Security benefit. Now, you can file as young as age 62, or you can defer that as late as 70. If you file at age 62, you'll take a 25% hit on your Social Security income, and you will take that reduced income for life. So it can be pretty meaningful. If you wait a little bit longer, you get a bigger check, and you get that bigger check for life. But that's the simplest complexity of Social Security. There are survivor benefits. If you were married to someone for a period of time of, I believe it's 10 years or longer, and that person passed away, you may qualify, if you were married to them, you may qualify for survivor benefits. There's also a spousal benefit where you can collect up to 50% of your spouse's benefit if that benefit's higher than your own. There are strategies where, let's say my benefit is $1,000 a month, my spouse makes $1,900, I might want to claim on my spouse's benefit 50% of $1,900 or $950 until I'm 70 years old, and then go to my own, and instead of collecting my $1,000 benefit, now I can switch to my own and get $1,250. So there's some strategies in there, and they're very complex. There are seminars out there that you can find these days, either at the Social Security Administration or from financial professionals, where they'll run matrices of based upon your personal situation. Should I file on my benefit? Should I file on my spouse's benefit? Do I take a survivor benefit? How long do I wait? You want to ask what the longevity is that you expect, what your other sources of income are. How reliable are those other sources of income? So we actually have an entire brochure similar to what you have. It's a strategy report. We call it the lens, looking through the lens of Social Security. So it's a very, very complex question for those of you who haven't filed yet. And I would encourage you to visit the Social Security office. That's probably the first place to start. Have them run your record. Make sure that you bring with you any former marriages that you've had, anybody in your life who you've been married to who might have passed away earlier. Your own earnings record will be part of the decision that you make. But Social Security by itself is a very complex question, especially if you haven't yet filed. Now, if you have filed, how did you file? Did you file on a spouse's benefit? Maybe you filed on your spouse's benefit because yours wasn't all that big and you did it 10 years ago, and what you realize is now you're 68 or 69 years old. If you go back down to Social Security and you say, hey, what is my benefit? You know, it would have been $800 at age 65 when I hit my full retirement age, but now that I'm 69 years old, maybe it's 20, 22, 25% higher. So even for those of you who have filed for Social Security, if you find yourself in a situation where you have a spouse that maybe had a big difference in income between your income and their income, it might be worth it to you to go back down to Social Security and take a look at that again. So that's Social Security, and it's a big, complex question. We just touched on it briefly today. The second thing that I want to talk about is with regard to pension decisions. Now, pensions are kind of becoming dinosaurs these days. There aren't a whole lot of companies that are launching pensions right now. There aren't a whole lot of pensions still left out there. But in this group, I would imagine that there's still a fair number of you who have access to a pension of some sort. And if you haven't yet started drawing that pension, there's some things you need to know about the election that you will make. Most pensions, and if you convert a retirement account to an annuity payout, or I call those private pensions, but they're annuities that have been converted to an income stream, there are several elections that you will want to be aware of. You can take a pension over just your life only. So I'm married, my wife Cherie doesn't work. So if I take a pension based on my salary from my company and I take it based on my life only and I die, it leaves her with nothing. It's called a life-only option. Now, that might be appropriate for you because it's usually the biggest check, but we better make sure Cherie's got some life insurance on me if we're going to do it that way, right? Because she will need to be taken care of if, for some reason, I die before I'm expected to die. That happens occasionally. Now, if you want to protect yourself from that, you can usually, a spouse can be eligible for some form of spousal benefit on your pension. You could have a joint and 100% survivor. That means if my pension's $1,000 and I elect the joint and 100% survivor pension option and I die, my spouse gets the same $1,000. I can sometimes, depending on my company and depending on my pension, I can elect, instead of $1,000 for my life or her life, I might get $1,100 while I'm alive and $665 after I'm gone, a 2/3 payout. Or maybe it's $1,200 while I'm alive and $600, a 50% payout. Okay, so as you consider your retirement income, not only will you want to pay attention to your Social Security benefit and how much of that is making up your entire budget, you'll also want to include any kind of pension considerations that you might have on top of that. So now we're starting to get into our multiple sources of income, and we're starting to have to decide how are we going to structure and engineer this income so that it provides you with the maximum benefit, the maximum amount of reliance. Maybe you have a pension that has an inflation option, but maybe your pension doesn't have inflation. Maybe you're going to have to rely on Social Security to keep up with inflation over time. Most people are going to be retired for a couple of decades at least if they live to a normal life expectancy. So make good pension decisions. Consider your survivors. Don't be afraid to buy life insurance and take that bigger check. Okay? That's a strategy called pension maximization. If I can get $1,200 for my life only or $1,000 a month for both of us, How much does $200 worth of life insurance buy? What if I can make up the gap by only spending $100 on life insurance? Now I've got an extra $100 in my pocket. So consider using a strategy that includes life insurance when you make your pension election, but make sure that you understand all of those options as you're heading down to the Human Resources Department and electing the pension benefit. Don't just automatically go for the 100% survivor benefit or the life-only benefit. Really give some consideration to how you might be able to maximize that using a couple of different tools. So I'm in the investment business, and the people that I deal with who are retired come to me because they have investments. And one of the things that they're often asking me is, well, what should I buy? What's the right stock? What's the right mutual fund? What's the right product for me? And when we talk about those multiple sources of income, one of the things that we often have the luxury of looking at is investment income. Because I'm in the investment business and I'm not in the real estate business, I don't have a lot of expertise in real estate, but I do want to touch on it. I believe that a good piece of rental property is what we call a growth and income investment. The value goes up over time. At the same time, it provides you income. You need to analyze all those expenses around that rental property just the same way you would as your own budget. What are my taxes? What are my maintenance costs? What is my cash flow? What are the alternatives? Okay, I'll tell you a story. I don't like I got a guy stuff because they usually take up too much time, but I got a guy. Actually, it's a girl. She's a lovely woman. She owns a great piece of property that's probably worth $400,000 or $500,000. It's a piece of view property overlooking the river, and it's got a house on it built in 1939. And she rents that house out because she's such a sweet lady for $575 a month. Okay? The property taxes on this house are $530 a month. I've suggested to her repeatedly, she's got a big heart, that she might want to deploy that resource in a different way. But don't do that with your rental property. There are other ways to maximize the value of the assets that you have, and that's one of the things that you want to do. Just like you look at each expense in your budget, look at each asset that you have. Does it provide you with rising income, fixed income, or variable income? So let me give you some examples. A certificate of deposit at the bank is a very, very safe investment. Your principal is guaranteed to be there every single year. When that thing comes due, you get a new rate. You get a new income. That's safe income, but it's variable income. And for most people on a budget, variable income's kind of dangerous. So while there are components of that CD that are really safe, there's also components of that CD that are dangerous. Let's talk about a bond. Most bonds, when they're issued, are 30-year bonds. Who wants to tie their money up for 30 years? Nice thing about a bond is it provides fixed income for a long, long period of time. It's generally income that you can rely on. And what about the stock market? Who in the world wants to invest in a stock market? I can't think of anybody who'd want to invest in the stock market, especially not right now. You read in the newspaper how high everything is. But do you know that Northwest Natural Gas has raised their dividend every single year since 1974? Who cares what the value of the stock is if every single year you get a raise? That's rising income. The best investment portfolio actually diversifies you by managing all of those risks, right? We need to manage the risk of variable income by adding on top of it some fixed income. And we need to manage some of that stock market risk by having something real safe like a CD. Okay? So while I don't want to talk about specific investments and whether they're right for you or not right for you, I can tell you that some of the most basic tenets of investing are to buy quality, to hold those investments for the long term, and to diversify. Okay, so regardless of the product that you're considering, you should ask yourself, how does this fit with the rest of my plan? The second thing that I want you to be really aware of, because it will keep you out of an awful lot of trouble, is please have an objective for each investment that you own. Okay, one of the questions that I got, and I knew I would get it, and I get it at every single time I speak, is, what about gold? Okay? Now, the new one is, what about natural gas? Or what about natural gas transmission? Or what about fracking? Or what about all this stuff that's going on in the Balkans? Okay, the United States is becoming an energy powerhouse, and how do I get in on that? If you're lucky enough to be in a position where you have that balance, right? Your income and your expenses are kind of matched. You might have a little bit of money over here on the side. And the question is, well, what do I do with that? The first thing you want to do with that is establish an objective for what it's supposed to provide. Okay, because it's probably only going to provide one of three things. It's going to provide you income now. It's going to provide you income later if you need it. We're going to get to that if you need it later in a bit. Or it's going to provide a legacy for somebody that you care about. Most likely somebody that you care about. Hopefully you've all done your estate planning, and if you haven't, you should do that. So let's talk about, as it relates to, I kind of jumped around a little bit. We talked about income and all the various ways that income is generated. Let's get to the resources in the same way we got to the expenses. Your biggest resource is likely one of two things, either a pool of investments that you spend a lifetime saving for, or your house. So how do I manage those best? I want to start with a house. There's a little thing called a home equity conversion mortgage that some of you may have heard of, more commonly known as a reverse mortgage. Okay, that's not my area of expertise. That's the real estate mortgage folks, but I do know that one of the ways, if you're over age 62 and you're looking to generate a little bit of extra income in your life, that's an option. Okay, I wanted to give you some resources there. In order to qualify for a reverse mortgage, I started with the official name of it because it's a home equity conversion mortgage. The first thing you have to have is home equity. Actually, the first thing you have to have is 62 years old. Second thing you have to have is home equity. Because if you don't have home equity, just like you made house payments for a long, long time, if you have equity in your house, you can find somebody that will make you payments for a long, long time. Now, they own your house, but you got the payment. So that's one of the things that you might want to consider if you're in that group of folks that really needs a little bit of breathing room and really needs a little bit of extra income. You can get either a monthly income or a lump sum. The first place to start with that would be the Department of Housing and Urban Development, or HUD. Okay, HUD is the government agency that oversees reverse mortgages. They have a great website. They also have a toll-free 800 number, 1-800-510-0301. If you want to look into reverse mortgages, I certainly would suggest that you start with those folks. So now I want to move to savings. If your house isn't your biggest resource, you might have a 401k. You might have a bunch of savings, IRAs, CDs, annuities. We talked a little bit about diversification. We talked about the difference between variable income and fixed income and rising income. The other option that you have, if you really want to generate a little bit more, let's say that I've got $1,000 a month of Social Security and $1,000 a month of pension, but I've got a $5,000 monthly budget. Okay, I like to live the high life. There's a $3,000 gap there, and I've got a lot of savings, and I can make that up with my savings. But maybe you don't like having that much of your income coming from some kind of a variable source like an investment account. I mentioned a pension. You can actually convert some of those assets to a private pension. It's called an immediate annuity. One of the cautions I would give you, if you think that that's something that might be appropriate for you, you should know that it's something you can rarely undo. So before you commit your assets to anything that sounds like or says the word annuity, make sure what you're getting into. There's two different kinds of annuities, and those income annuities are really private pensions, and they are typically irrevocable. I want to talk about tax issues a little bit because a lot of times people make investment decisions based solely on tax reasons. We call that letting the tax tail wag the investment dog, right? I have a few clients like this. They're clients who say, I need another tax-free bond. There are such a thing. And I ask them, well, what tax bracket are you in? Well, I'm still managing to avoid taxes. Taxes aren't necessarily a bad thing. Again, it's about maximizing the efficiency and not charging $500 for your rental house when you could get $600,000 for the principal. Okay, tax-free bonds are great if you're in a high tax bracket. If you're in a low tax bracket or a no tax bracket, you might want to buy a taxable bond and go ahead and pay a little bit of taxes. So don't let the tax tail wag the investment dog. You know, you can hire a professional financial advisor, and a lot of people do that, but a lot of people don't. I think that the primary reason, there are two primary reasons really why people don't ever go see an investment professional. The first one is we have a terrible reputation, and they just don't know who to go to. They really don't know where to start. I apologize on behalf of our industry that there are folks that are out there who every single day they go to work and all they want to do is sell more stuff. There are some great ones out there. They'll ask questions about you. They'll ask about your family. They'll ask about your expenses. They'll ask about your resources. They probably won't charge. There's a few of them that charge by the hour, but most of them don't charge for a consultation. And I can tell you, as one of those people that goes into the office every single day and spends all day doing investments for clients, it's an extraordinarily complex world. I can barely keep up with it. So for those folks who try to do it on their own, I have met a few that are perfectly competent and capable to do that, and if you are one of them, go for it. Doing it on your own is absolutely less expensive than hiring somebody. But hiring somebody is only incrementally more expensive than doing it on your own. And if you get the right person and they do the right things for you, the results that they can help you achieve will far outweigh anything that it costs you to hire them and to have them on your team. So I do think that you want to consider all of your different sources of income, all of your different resources. I think that you want to look at possibly having somebody that you can sit down with that's an expert in the field to help guide you. I think that you want to make sure that you have an objective for each investment that you buy and that you understand it fully. That's the other nice thing about having a professional. They should be able to explain to you what it is that you own and why you own it. Remember I said you need to have an objective for everything. Is this for income now? Is this for income later? Is this for a legacy that I'm going to leave? Why is it going to achieve that objective? And how much is it going to cost me to buy this? What is it going to take to manage it on an ongoing basis? And what should I expect over the long term? Those are all fair questions. I would encourage you to have some help with that. I want to finish with risks. I mentioned that the only thing that can upset your financial security is an increase in your expenses or a decrease in your income. The most common increase in expenses for someone who's in retirement, which is the major group that I work with, is long-term care issues. You know, we're all going to die, and those last couple of years, 2, 3, 4, 5 years, can be really, really expensive. $5,000, $6,000, $7,000 a month is not uncommon. If you're married and you don't have the financial wherewithal to add $5,000, $6,000, $7,000 a month to your income from one of those resources that you have out there, you should consider an insurance policy. Typically for a 65-year-old, a policy that pays $4,000 a month is going to be somewhere around $3,000 to $5,000 a year. Okay? If you're talking about protecting a $400,000 investment pool that's generating a third of your income, why not take 1% of that pool each year? You're either going to get sick or you're not. And if you get sick and it ends up being expensive, the last thing you want to do is deplete that big, huge pool and leave a spouse with not enough resources to live the rest of their life. So I would encourage you, if you haven't already considered it, to think about what you might do if in the last 3 to 5 years of your life things got real expensive. And I think the short answer is that you consider insurance. That's not an appropriate answer for all of you, so I don't want to generalize. I think it's individual according to your specific situation. But for people who are in the last few years of their life, that is one of the most common ways expenses can go up. And expenses going up is one of those things that can upend your financial apple cart. The other one is inflation. Inflation's a little bit insidious. It happens little by little by little by little. I can tell you I've been doing this for 20 years now. I know I look way too young to be doing it for 20 years. Inflation doesn't go up at 3% per year. The way that it works is you go along with this income every single month, and you're doing fine, and you're doing fine, and you're doing fine, and then you kind of realize one day that the bank account isn't as big as it used to be. And you think, now, what am I going to do? What you're going to do is you're probably going to call your financial advisor. You're going to say, you know what? Things have been a little bit lean. You got to start, I've been getting $1,000 a month, but now I need $5,000 to replenish my savings account. And then you're going to go along for another year or year and a half, and boy, now you need $7,000 or $8,000 or $9,000 from your investment account or your IRA. You're going to pull out some principal somewhere, or you're going to have to sell off that old trailer that's been sitting on the side of the house. Okay, and the next thing you know, you realize that you don't need $1,000 a month. When you really sit down to finally analyze your budget and wonder why your principal is disappearing so fast, you found out that over the last 10 years, your costs went up by 50%, and now you call your financial advisor and you say, I need $1,500 a month instead of $1,000. That's how inflation works. It's going to be that way for all of us. And I'm not here to scare you about what the implications of inflation are. What I want you to ask yourself is, how are you going to deal with it? What provisions have you made to provide yourself with rising income in retirement so that you can at least keep pace with inflation? I want to finish by reminding you that God is in control and wants our best. That was the last line of your email, Bill. We are never going to be able to control the world. We're never going to be able to solve the political problems. We can't possibly, even an intelligent, brilliant group like this can't build that bridge by ourselves. That CRC bridge, right? We can't do it with or without light rail. We can't impact the Federal Reserve and where they're going to set interest rates next month. But we can do an awful lot with our own situation to make sure that our financial security is as good as it can be. We can be good stewards of those resources by analyzing all of our expenses, by maximizing all of our incomes, by making sure that our resources are appropriately managed, and by protecting against the risks that we know are going to exist in our financial life. I can't tell you when the stock market's going to go down 10 or 15 or 20% next, but I can tell you that it will. So what are you going to do about it? I think you take the income, expenses, resources, and risks in your life, and you tackle them one at a time. Thank you very much for your time. Do we have some time for questions, Bill? All right. Yes?
How do you feel about CDs, for instance, that are purchased through, I'm aware of one through a Christian organization for church planting, but it's not FDIC insured.
All right. You said an interesting thing. You said CDs purchased through a church organization that's not FDIC insured. It's not a CD. CDs are FDIC insured. A certificate of deposit issued by an institution that is either NCUA, National Credit Union Association, or FDIC, Federal Deposit Insurance Corporation, those particular investments, your principal is guaranteed. Through a church organization, your principal is not guaranteed. I can tell you, I had a client very, very angry with me a couple of years ago because she had a portfolio of about $2 million worth of church bonds from various entities, and she was very frustrated because none of those church bonds were sending their income payments. They were all in default. And she said, I don't know what to do. Can you handle this account? And I said, of course, we'll transfer this account in right now, and we'll work as those interest payments come due. She had some other stuff too that she needed us some help with, but the big thing she had was a couple $1 million worth of church bonds, and it was sitting on the books at Cambridge Investors at $2 million. And when she transferred it into our Edward Jones branch, we have a policy that we only price securities that we can reliably find a price for. And her $2 million account was worth $19,000. True story. And the reason it was $19,000 is because all but one of those bonds were in default. They weren't paying the interest. If you are going to buy church bonds, there's some awesome ones out there, and you're doing great work by helping plant and build churches. but you got to be able to do your due diligence, and there are a few organizations that specialize in that. Ours isn't one of them. I would tell you that would be appropriate for, just like all investments, there's a portion of your investments that can be in just about anything. Okay? I would consider non-publicly traded, unregistered debt securities of any issuer to be a high-risk income investment. And as such, no more than 10% at the very most of your investment portfolio should be in anything like that. Great question. There's a lot of stuff out there. There's also private loans, same thing, unregistered, non-publicly traded. They're considered high risk. You can do personal mortgages for folks where you give someone a mortgage personally. There's no regulation on who can or can't originate a mortgage. But again, those things are things that are considered high risk and appropriate for only the smallest portion of your savings. Great question. Anything else? Saw a couple hands. Yes, sir.
Could you explain the importance of cost basis on investments?
Absolutely. So cost basis is the cost of an investment according to the IRS. Not necessarily what you paid for it, especially if you inherited something. But if I buy some Apple stock at $200 a share and it goes to $400 a share and I sell it, my cost basis is $200 a share. I sold it at $400. I have a capital gain of $200 and I have to pay taxes on that. Okay? That's a simple example. It gets a little more complicated than that. If Apple's paying a dividend and I'm reinvesting that dividend, every time I get a dividend, I have to pay taxes on it. And when I reinvest it, it adds to my cost basis. So if I buy Apple at $200 a share, it goes to $400 a share, and during that time it pays $50 worth of dividends, and I reinvest those dividends, my cost basis is $200, what I paid for it, plus the $50 that I reinvested. Now I sell it for $400, and I have a $150 capital gain because I already paid taxes on the $50. Now if I die and my wife inherits the Apple, or let's say my son inherits the Apple at $400 a share, and he immediately goes out and sells it, he doesn't owe any taxes at all because he inherited it in the state of Washington. We get a step up in basis, and he inherited it at $400 and wasn't considered to have a capital gain. Are there other components of that you want? There's also capital losses. It's a question that can be more complex than that, but the very basis of it is cost basis is what the IRS determines your cost of an asset is. It's not always what you paid for it. Other questions? Yes, sir. Great question. So a CD is a financial product. A Roth IRA is a type of account. That would be equivalent to having a garage and a car that goes in the garage. So the Roth IRA is a type of garage. The CD is a type of car. Roth IRA is a specific type of account that has preferential tax treatment. So IRAs, 401ks, annuities, there are several different vehicles out there that have preferential tax treatment of some kind from the IRS. A Roth IRA is an account that you put after-tax money into and you take out tax-free money. So if I have a Roth IRA and I contribute $5,000 to it and I put it in Microsoft stock in 1980 and that $5,000 grows to $500,000 and I take it out, I got $500,000 worth of tax-free money. I don't ever have to pay taxes on that gain I made in a Roth IRA. In a regular IRA, I get to take a deduction for my $5,000, right? So I don't have to pay taxes on it today. But when I take it out, everything I take out is taxable. That's the difference between regular IRA and Roth IRA. Yes, sir.
Wouldn't it be common sense then not even to open a normal brokerage account any longer? Just go to a Roth IRA?
There's limits on how much you can contribute to each of those. So depending upon how much income you make and where your money, you can't put all your money into a Roth account. The IRS limits how much you can put into some of those types of accounts. So there's a little there's a difference between the garage we're building, that's the type of account. Is it a brokerage account? Is it a regular IRA, a Roth IRA? Is it an annuity? And what's the product that goes in there? Do we have CDs in there? Do we have stocks in there? Do we have mutual funds in there? Are they managed accounts or unmanaged accounts? So a little bit of a difference there between the type of account that we're opening and what we're actually investing in once we put money into it. To answer your question, it would be great if we could take all of our money and put it into a Roth account. That'd be fabulous. As long as you were smart enough to make your account go up, you'd have all kinds of tax-free income. But they don't let us put unlimited amounts in there.
Being that they don't tax the income on a Roth IRA, they probably would not allow losses either.
The way that a Roth account works is, let's say I put $5,000 into my Roth and I buy a bad stock and it goes down to 3. When I take it out, it's not taxable anyways, whether it's 3 or 30. So the losses, I don't get to write off those losses. Yeah. In a Roth. Yes, sir.
What protection or how would you say it, is available in the industry, the investment industry, to prevent unusual fees to the point where your investor is actually stealing from you?
That's a great question. We've had some of that. Bernie Madoff, anybody know that name? Okay. The question is, what kind of protections are available in the industry to make sure that there aren't extra fees being charged or there isn't, just call it dishonest business practices. So a couple of things that I would tell you. In my industry, there are folks that are operating out of their office in their home. They got a handful of clients, and they've signed a broker-dealer agreement with XYZ broker-dealer, okay? Nobody watches them. There's very little supervision. There's very little research. They're doing their own research. Some of those folks are fabulous, and they have your best interest at heart. Some of them aren't. I don't know the difference between the two. I think they're hard to tell. I think you get some Bernie Madoffs occasionally. One of the protections that you can consider in a situation like that is do business with a reputable firm. Go to a Morgan Stanley, go to a Merrill Lynch, go to an Edward Jones, go to a professional financial services firm that has some size and scale. It is highly likely that the compliance in that firm is much better than in a little tiny place where a guy's hanging up his own shingle. Now, I want to tell you, we have some wonderful people in this community who hang up their own shingle and do a really great job for their clients. So you shouldn't be fearful if that's where you're at. But ask those questions, which would be the second part of my answer. Why do I own this investment? How does it fit my needs? What does it cost? So there are a few products. I wish I had brought the quote. There's a few products out there that are designed more for the salesman than they are for the customer. They're easy to sell, and there are guys out there that are selling them. If you ask the right questions and you get an uncomfortable feeling about the answer, you might be sitting with one of them. There's so much competition in the financial services industry. There's some great people out there, and unfortunately, we have some predators out there as well. Interview multiple people. Ask your accountant, ask your attorney, and then go see a couple of folks. I had 2 here. What's that? Well, and there's so many things. You got to get your statements, and you got to look at them, and you've got to read them, and you have to understand what it is that you're paying. There's fee-based accounts. There's brokerage accounts that charge by the transaction. There's a few out there that charge both. You really want to understand what the costs are, and you want to understand what you get for those costs. You want to understand why you pay those costs, and you want to recognize whether or not those costs are fair. I can tell you that no matter what kind of account that you have, somewhere around 1% per year is about what's normal. There's a few that charge a little more and a few that charge a little less. Even in a brokerage account, if you're being diligent about buying and selling at appropriate times, you're still going to end up paying a commission a couple of, every once in a while. But about 1% per year. Anything more than that, I don't want to say more. Let's say 1 to 1.5 is pretty normal per year. And they're not all fee-based. Some of them only charge when there's a transaction. So you got to know what, I think that's great. Understand the fee structure would be the takeaway for that. Definitely. What am I buying? Why am I buying it? How much does it cost? And how do they charge? Great questions. Yes?
I'm a little bit confused. If you have an IRA, or regular IRA, when you go to draw that money out, you're going to pay taxes on it, right?
If you have a regular IRA, when you go to draw that out, you will pay taxes on it. You don't pay any taxes until you draw the money out. But once you draw the money out, you're going to get a 1099-R at the end of the year from whatever firm holds it, and that is taxable on line 14A of your 1040 form. Lump sum, if you take the whole thing out, then the whole thing's taxable in the year in which you take it out.
Take out so much a month to add to your income, then it's not quite so much. Is it a lower tax bracket?
Still by the annual withdrawal amount. It's all relative. If I take out $1,000 a month, I owe taxes on $12,000 of income at the end of the year. If I take $12,000 out in January and nothing out the rest of the year, still $12,000. They're going to add it up for the whole year, and at the end of the year, you're going to have to pay taxes on whatever you withdrew.
If you put your money into a Roth IRA, you don't have that problem?
If you can.
Pardon?
If you can put your money into a Roth IRA.
When you say if you can, does that mean that you have to be working in order to put your money in there?
In order to make contributions to any retirement account, you have to have earned income. And there are limits to how much of that earned income you can put into the retirement account. So just like you can put in up to $5,000 per person per year into an IRA if you have earned income, 6 if you're over, I believe it's 50. There's a $1,000 catch-up. Same rules apply for a Roth IRA account, but there's also limits as to how much you make. If you make too much, you can't put money into them. So you can only put $6,000 a year in unless you make too much, and then you can't put anything in. You can always put money into an IRA, but you may not be able to deduct it from your taxes. Complicated stuff. Probably best done on a one-on-one.
I understand what you're saying on all of this stuff, but one thing, why is the stock market doing so well, running up almost 15, when the rest of the nation is flopping?
That's a great question.
That Federal Reserve, I don't know what's wrong with them, they're crazy. If I had my way, they'd be hanging from the
Let me go back to the first part of my outline where we said what we weren't going to cover. I can tell you that the stock market, one of my great challenges as a financial advisor is to remind people that the stock market is not its own entity. The stock market is an amalgam. It is a statistical report based upon underlying events that happen every single day. When General Electric, right, who has been getting lean for years and years and years and used to have a big, huge debt problem, but is now benefiting from interest rates falling and falling and falling, and they're refinancing all of their debt, right? And the construction industry starts coming back up, and Boeing and everybody else starts building more airplanes, and GE finances a whole bunch more of that stuff. When General Electric by themselves has a good quarter or a good year, that has an impact on the stock market, but only an impact. The stock market is not its own thing. It's a collection of the results of hundreds and hundreds and hundreds of companies. And I can tell you that corporate America was as frightened as all of us were when Lehman Brothers went belly up, when the banks looked like they were going to fail, when Bernie Madoff got arrested and a whole bunch of CEOs got thrown in jail. And corporate America has spent the last 5 years cleaning up their books. They've reduced their debt. They've improved their cash flows, their capital positions. They're in way better positions now than they were 5 years ago. And guess what? Now, not only are they healthy, but we're experiencing a little bit of an uptick in the economy. This kind of recovery that we've got going is gathering some legs. So companies like General Electric and like Johnson & Johnson, Google, whatever it is, each individual company that's out there, there's a whole bunch of them on the main that are having a lot better time now than they were a few years ago. Doesn't mean things are still racing forward. These aren't the good old days. But fundamentally and financially, corporate America is in a lot better place than it's been in quite a long period of time. How much time do we have left, Bill?
Couple more questions.
Couple more questions. Yes?
Okay, say you
only wages. If you don't get a W-2, you can't put that money into your IRA. Did I see one in the back? How about gold and silver? I told you that was going to come up. If you remember, one of my admonitions to each of you as you buy investments is to have an objective for everything that you own. It's either income for you now, income for you later, or to leave a legacy for someone else. Gold and silver don't do a very good job of achieving any of those objectives. They're one of a lot of commodities. They're the most popular one of commodities. I've yet to have someone in a workshop raise their hand and say, "What about pork bellies? Frozen concentrated orange juice, wheat futures." It's just another commodity in a basket of stuff that's probably not appropriate unless you're making gold plating, unless you're, I don't know, I guess we could send some over to Korea. Maybe they're making nuclear warheads with gold-plated connections and stuff like that. I mean, there's really 4 places where gold is used. Gold is used in industrial manufacturing, gold is used in jewelry, gold is used in national reserves, and gold is used for collecting. I can tell you that industrial manufacturing capacity of gold has been falling as the economy falls. Countries are broke. They're not adding to their gold reserves. If anything, maybe they're taking away. Okay? Jewelry, there isn't a whole lot of jewelry being bought in a recession. So all of that excitement about gold has been made up by collectors, and collectors haven't been doing so well lately, so they're getting less interested and gold has been falling. So that's not an environment where I can find an investment that achieves my objectives. It's not the kind of market where a company that's doing a great job can bring value and increase their, you don't see companies getting better and better and better at making gold bullion. There's no way to add value like a company that used to make widgets and they used to cost 10 cents a widget to make, and now because of manufacturing and technology and things they've been able to do, now those widgets are only 8 cents to make, and the company's more profitable because of it. I want companies that have the capacity to improve their business going forward. And unfortunately, commodities don't do that. That's kind of a gamble unless you're in oil, and you need oil because you're going to refine it into gas. Then you'd buy a commodity like that. But a good question. Yes?
And there's a couple of things that you didn't mention as far as why the stock market's doing what it's doing. With QE1, QE2, QE3, and now QE infinity, all these trillions of dollars, taxpayer dollars, are going into the market. They've got to go somewhere. Bill Gross, bond king, said we're the cleanest dirty shirt on the street, so where is it going to go?
Yeah, I think that there has been a little bit of leakage into the equity markets for that. That said, I don't think the equity markets are all that overvalued at the moment. In fact, I think they're probably pretty fairly valued. Corporate America is better and stronger and healthier than it's been in a long, long time, and the stock market reflects that. I don't know how much of the quantitative easing and this is a complicated economics discussion, but I don't know how much of that stimulus has made its way into the stock market, but it's likely some has. I'm thankful for it. It's been great for the portfolios that I manage. I don't know how they're going to unwind it either, but at some point there's going to be less stimulus. I have a lot of faith in the fiscal, I don't want to say fiscal, I would rather say monetary management of what has happened in our country in the last 5 years. It could have been a whole lot worse than it was. And I think there have been some really good choices and some really good decisions and some really good tools launched in a way that has mitigated what could have been a lot worse. So I'm not all that fearful about monetary policy right now. Are we all done?
We are.
All right. Thank you all.
I tell you what, I for one am glad that Andy is on our team. Amen. Amen.